Now, tomorrow we're going to get first quarter earnings from some big banks that are coming out. Citigroup, JP Morgan Chase and Wells Fargo all reporting. And we'll get earnings from one of the most prominent regional banks in the country, PNC Financial. Now, these reports will cue investors in on the impact from the banking crisis. Our next guest says banks generally set the tone for the health of the economy. So what kind of reading can we expect? Well, joining us now is Amy Kong, CI Barrett Private Wealth Chief Investment Officer. Good to have you, Amy. Now, it's interesting because this isn't your typical period for banks, given the fallout from SVB. So how might this be different? Is this still going to be setting the tone of what to expect for the year in this quarter, or should we wait till next quarter?
Hey, guys, thanks for having me. Great to see you. I think this quarter will be important, but next quarter will be what investors will be focusing on. I mean, don't forget the fallout from Silicon as well as Signature happened in March, so well into the first quarter. So really don't have a lot of time within the first quarter to see the fallout from some of these troubled banks. And so I think investors will be focused on a couple of things as we're unfolding bank earnings tomorrow. One is deposit trends. Clearly, the deposit trends will be quite different between larger versus medium-sized banks, and we're going to watch that pretty carefully. We should also expect that the tone should be probably more downbeat. Perhaps there will be a suspension of buybacks. I think capital ratios will also be elevated just in light of all the banks becoming a little bit more cautious, becoming a little bit more conservative going into the remainder of this year.
Yeah, when you look at the way per share earnings estimates have been written down, it's actually 24 where we're going to see perhaps, according to the analysts, the biggest drop. We started Q1 with bank CEOs, I believe every one of them calling for a mild recession. What do you expect them to say about the tone of the economy, in particular Jamie Dimon?
Yeah, I mean, his annual report is a good tone setter, if you would. A lot of people pay attention to that. And the Fed minutes from yesterday also agreeing with his annual report. So I think the tone is likely to be downbeat. I think banks, as I've mentioned, will continue to play the conservative card. Not only because of all that's happened. I mean, if you think about the banks in general, they've got bonds that are sitting at a loss. They are probably thinking about, which is the next bank to experience a bank run. We hope not. And so I think the key is to keep liquidity as high as possible. And obviously, when you have that scenario play out, it will eat into profits. And so I would not expect, much more than a downbeat tone going into the next couple of days of earnings reports.
And obviously the Fed keeping an eye on that financial stability while also, of course, trying to get inflation under control. I want to talk about some of the moves that the Fed should be making. A lot of people saying perhaps they're being too aggressive, obviously still looking at some of that backward data there. Are they perhaps missing that the medicine has taken hold and that perhaps they should pause at the next meeting?
It's a great question. I think they ponder that on a daily basis. What I think has been supportive is the fact that CPI and PPI numbers have come down, but they are still well ahead of the Fed target. What I'm thinking, what Barrett's thinking as a group here is that the May meeting, which is only a couple of weeks away, we should still see another 25 basis point hike. From there on, you will get another couple of data points. And if we start to see CPI numbers or inflation data points continue to cool at the same measured pace as we've been seeing, then perhaps there could be a pause. But I think it would be premature to start pausing again in light of the data that we have seen. What we have also been observing is that the March numbers are 1% lower than the February numbers, but that's really a more mathematical thing where March of last year was a very high number and that got dropped off in terms of the calculations. And so I think the Fed really needs to see inflation stay lower and not shoot up again for whatever reason, supply, demand, et cetera, before they start thinking about a pause.
And the pause is one question. The cuts is another. Market's still pricing in a cut to rates later this year. What's your expectation?
We're in the camp that a cut is probably less likely for 2023. A pause is more probable depending on data, as I've mentioned. Now, if we do enter a recession in the back half of this year, which we should expect, or we could expect, the severity of that potential recession will determine if cuts are necessary. At this stage, it's still too soon to tell, but if we start to see Again, the severity of a recession becoming a little bit more than what we're originally anticipating, then potentially cuts into the back half of this year, into first quarter of next year is likely, but we're not in that camp right now.
So as some investors get perhaps a little too ahead of themselves, waiting for that pause and that pause in rate hikes there, I want to ask you what you're seeing in terms of the intermediate action for stocks. What are your expectations for the next 6 to 12 months? What are you focused on?
Sure. We're watching the Fed obviously very carefully. I think, don't fight the Fed continues to be top of mind for many investors, and we believe in that quite very much so. Earnings, obviously, over the next couple of weeks into next month will be very important as well. Not only are the bank earnings very important, but we're going to be watching consumer-related stocks as well. One of the things that's been somewhat conflicting in all of this is the jobs market continues to be quite tight, and how we're really seeing or trying to see is whether or not the consumer and consumption continues to hold up. Right now, wage inflation is still positive, 4, maybe 4.5%. But if the cracks within the labor market starts to show more and more, that will obviously impact sentiment as well as consumer trends. And that's something we're going to keep in mind quite a bit over the next several quarters.
Certainly the strong consumer keeping the economy afloat at the moment. But as you mentioned, we'll keep an eye on some of those cracks that are still in the system. Amy Kong, thank you so much for joining us this afternoon.